M&A activity taking a huge hit in 2022. Global deal making dropping 37% from 2021 levels, and Q4 marking the lowest volume that we've seen in about 6 years. So what's in store for the year ahead? Citizens is out with this 2023 M&A outlook, and here with more on that, I want to bring in David Dunstan, Citizens Managing Director, Head of Industrials. David, it's great to see you here. So certainly we saw significant slowing in M&A in 2022, of course, coming off what was a pretty hot 2021. But what does 2023 this year have in store?
Well, the survey certainly suggests that company owners and executives, as well as private equity partners, feel bullish about activity levels and expectations for 2023. That sets the stage for a much better environment than what we witnessed in 2022. The survey itself includes 400 respondents, so we have 275 C-suite executives, as well as 125 PE partners who have their finger on the pulse of what's happening with their companies and in the environment in general. So we're enthusiastic about the optimism despite some headwinds as we enter 2023.
And if we could, David, let's jump into some of the sectors where we think we might see some M&A activity.
Absolutely. So, for example, I run the industrials group at Citizens. We have 9 or 10 different industry verticals across our platform. As you look at industrials, for example, we see the effects of reshoring. We see the effects of the infrastructure bill, the impact of electric vehicles, electrification of the grid, the demand by data centers for equipment and infrastructure, as well as automation. These are 1, 3, 5, 10-year type incremental cycles that we think are very important, driving deal activity for manufacturers of equipment, parts, components, service providers, as well as distributors of these materials. So in the industrial space, while there may be some volatility quarter to quarter as the M&A market operates more on a longer term perspective, we feel really good about that platform. In addition, we saw bullishness in aerospace and defense, business services, and seeing expectations across various verticals for a much better environment for deal-making activity, given some certainty around interest rates, around the possibility of a recession, and comfort with regard to company performance based on the feedback and statistics we're seeing in the survey.
David, what about valuations? Because 2022, the worst year for stocks that we've seen since 2008. But reading through this survey, company valuations are expected to stay stable or higher. 80% of company valuations expected to stay stable or move higher, which is pretty optimistic given all that uncertainty, given the fact that the Fed's saying it's going to remain aggressive, rates remain high, inflation still has a ways to go in terms of easing. Why are we seeing that optimism?
Well, it's interesting. Another statistic in that survey suggested that over 90% of the companies are expecting their company performance to be better than last year as well. And again, I think there's what we have seen over the last few years is real resiliency in companies. They've overcome the effects of COVID, supply chain, raw material, labor, a war in the Ukraine, for example. In 2022, we saw the effects of interest rates increasing, leverage finance pullbacks, et cetera. These things have been challenges companies have continued to address, face, and determine how to operate within that environment. As we enter 23, we feel as though from the survey results and our own practice, business owners, PE executives, capital markets participants are getting more comfortable operating within this unusual environment. And that amount of comfort and certainty with regard to thinking about a forecast, thinking about projections, thinking about performance gives people comfort that you can get deals done and get them done at a reasonable valuation, as good or better than what the expectations were in 2022.
David, you talk about resilience, but there's also been some resistance on a federal level to some of these major acquisitions. And of course, I'm talking about Microsoft and Activision Blizzard and the publishing action between Penguin Random House and Simon & Schuster. Has there been any type of chilling effect from those federal actions?
Yeah, there's no question that there's been a little more increased scrutiny with regard to the regulatory environment. We're seeing that across the board with regard to HSR, and getting various approvals, CFIUS, other matters that fall into that regulatory environment. That does create some challenges with regard to deal making, but like with regard to interest rates, with regard to COVID, supply chain, raw material prices, et cetera, deal makers, advisors, lawyers, executives, we're finding our way through that minefield. Sometimes it's taking a little longer. There's a longer, more in-depth review process, but overall, for the most part, so there are some high-profile deals that have been blocked or roadblocks have been put in place. But for the most part, we are finding our way through that maze and making progress despite some of the regulatory headwinds that you have to throw into the mix here as well.
Good to hear things could open up in 23. Citizens David Dunstan, good to see you. Thanks so much.